Hi, good evening. This is Business Plus. I'm Karthik Malhotra, and let's dive in straight into an action-packed next 45 minutes. And to begin with, what else bigger today than, of course, in addition to the stock market crash of over 1%, Asian Paints Q2 results. Sayash Maheshwari joining me in the studio.
Hi, Karthik.
Take me through the numbers, Sayash. Hi, nice to have you back with us.
Thank you.
How are we doing on numbers? Below expectations?
Yes, the numbers are actually below expectation on all fronts as far as revenue is concerned, profitability is concerned, margin is concerned. Now, profit for the quarter gone by stood at around 1232 crore versus 803 crore in the previous quarter. Now, as per our expectation, profit was expected to rise to about 1287 crore. So, a 4% miss on the profitability front. Revenue for the quarter stood at around 8,479 crore, a 0.3% rise on a year-on-year basis. But you know, from our expectations, it was down about 6%. We had expected revenue to come in just above the 9,000 crore mark. EBITDA, which is the operating profit, was also below our expectations. We were expecting EBITDA to come in at around 1800 crore, but for the quarter it came in at 1717 crore, which on a year-on-year basis is a jump of about 41%, but it's about 4.6% lower than what we had estimated. Margins also came in lower. On a year-on-year basis, they were up about 580 basis points, but about 68 basis points lower than what we were expecting. We had pegged margins to grow at about 630 basis points or so. Now, the company said that the revenue miss could have been because of the impact of the monsoon. They said that the buying that they see during the Diwali season could have been pushed from September to October.
Because of the delayed Diwali
Yes,
itself.
also Diwali is coming in, I think, about 2 weeks later
That's
than
right.
the previous year. So that's why we are seeing a very small 0.3% rise on a year-on-year basis as far as revenue is concerned.
Okay.
The company also talked about constrained profitability as far as its international businesses are concerned. So domestic business is hurt by the sentiment. International business profitability is not coming through for the company.
All right.
So all in all, numbers are not looking good for the company. But the guidance, the company has come out. We'll obviously hear more from them during the earnings con call, which is scheduled at 5 p.m. this evening. But the management, after the initial print, has said that they are optimistic about the demand, given that festive season and the wedding season is about to kick in. So Q3 will be good, will be better than Q2, and and the overall buoyant economic growth conditions. So as far as Q3 and Q4 are concerned, they are expected to be better than Q2.
All right, let's hope Q3, Q4 numbers come out better, but let's also go across right to Avinash Gorakshakar, who joins us. Avinash Gorakshakar, Director Research, Profitmart Securities, joining us live. Hi Avinash, good to have you back with us. Good evening.
Yeah, good evening.
So how are you reading the Asian Paints numbers this afternoon, Avinash?
I think broadly, numbers have been in line, but I think the market was expecting a stronger growth in the volume growth for the decorative segment. And as far as margins are concerned, I think the market should be looking at the outlook on margins very closely once the con call gets finished. Largely because competitive intensity in the paint market has increased quite significantly. We got new players like JSW, Grasim, who have entered the market. So I think despite a festive kind of period, which is well known, for the third quarter of this financial year, margins are going to be very important. So I think, I would say that the numbers are in line, but I think for a better understanding and more conviction, I think the management commentary and the outlook which would be shared by them would be very important.
Absolutely, and that is expected in a few minutes from now. But let's stay on these numbers, Avinash, and I want to understand from you a revenue rise of just 0.3% versus a net profit rise of 53% upwards. How do you explain this sort of, imbalance between rise in revenue and supernormal rise in profits, and yet you're saying it's below expectations?
See, normally, when you look at the financial performance of any company, I think you've got to correlate it with both the top line growth and the profitability growth. So in this scenario, revenue has not even grown by 1%, but the profitability has jumped by almost 53%. So which clearly means that there has been some abnormal, kind of rise in other income, or typically, maybe the, some certain costs have been eliminated in this quarter. But if you look at a normal quarter, what the market would have expected is a strong value and volume growth in top line, and a reasonably steady growth in the profitability. See, this kind of profitability, honestly, whether the company can sustain it quarter on quarter for the next 2 to 3 quarters is something which is quite questionable. So I think qualitatively one needs to look into the numbers rather than just looking at the bottom line number.
Absolutely. And I think Diwali around the corner, another 20 days or so from now. So Q3 numbers should give some sort of, Diwali should give some sort of a fillip to Q3 numbers in your opinion?
Yeah, definitely. See, Q3 has traditionally been a very strong quarter for all the paint companies. And I think, obviously rural demand, urban demand picks up quite well during this period. So I think you're going to see a lot of, activity, a lot of, paint consumption in this period. I think the key crucial factor would be, what is the outlook on raw material prices, especially crude oil prices, which has now reached almost $90 a barrel.
Right.
For Asian paints, crude oil price is a very important variable. So I think point number one is what is the price trajectory expected there, and secondly, in terms of the competitive intensity, see, we all know that JSW and Grasim have entered the market with extremely cost competitive kind of prices. So I think we will obviously get to hear all that from the management. But I think this apart, the third quarter should be better than the second quarter.
Right. So while we await, I think management commentary coming in maybe in a couple of minutes from now, it seems that Q3 could see the revenue really bolstering up, but margins being under pressure. But Sayash, how's the stock taking the results that have been announced today?
I mean, before I get to the stock, I think one of the reasons why we are seeing this sort of a beat in profitability is because crude prices softened from a year ago period. I think, we were just coming out of the Ukraine war. The crude prices pretty much throughout Q2 of last year were, trading between the range of $95 to about $110.
Right.
And as we know, crude prices are a big part of, raw materials for paint companies.
Pure input cost.
30% or 35% of the entire input cost. So that's why I think we are seeing about a 50% rise in profitability. I mean, I don't know how much of that also comes from the operational efficiencies that the company has, created over the year.
Right. Let's talk about the stock. How's the stock being?
As far as the stock is concerned, the Asian Paints stock was down about 2.5% before the results.
Okay.
We saw about 1% decline after the results came out. So in the end, the stock ended at 3.59% lower for the day at 29 and 51. And I'm also looking at the stock compared to other paint manufacturers as well. I think Asian Paints has been a clear underperformer in the last few months or so. I mean, if you look at the 1 month return, Asian Paints is down about 10% so far. Berger Paints, on the other hand, is down about 6%. Nerolac is down about 3% or so. If you look at the 6 months return, Asian Paints has given returns of about 2%. Berger is up 11%.
Okay.
Nerolac is up 26%. So Asian Paints has clearly been an underperformer in the last few months or so. And as Avinash was also saying, Grasim is about to enter the market.
Absolutely. One more big elephant walking into that beautifully painted house or yet to be painted house.
And it's aiming for the second spot. So it's definitely going to eat away from some of the market share from Asian Paints because it's at the end of the day the largest player.
Absolutely. So who takes the biggest beating, Avinash? Where are the shots really going to be felt the hardest? Would it be Asian Paints? Would it be Nerolac? Would it be the entire painting block? Or where do you really see the bloodbath really coming in with this new added competition from Grasim?
So I think my guess is, earlier, there were expectations that Asian Paints would also cut prices. But I think looking at its market leadership, possibly the smaller players like Berger or ICI, these are the typical companies where possibly initially the effect of market competition could come in. And thereafter, as volumes increase for Grasim and JSW, I think you could obviously see that, market share erosion happening for Asian Paints also, because ultimately it's a commodity product. And frankly, looking at the pricing strategy of both JSW and Grasim, we believe that, pricing is going to be a very key element in volume expansion for these new two players.
All right. And tomorrow is another big day when it comes to numbers coming out. We've got Maruti Suzuki and we've got Reliance Industries. Avinash, what are your expectations from Maruti and Reliance?
See, Maruti, I think, should show a decent set of numbers because volume growth has been quite impressive. And most importantly, margin pressure is likely to be a little softer considering the softer trend in commodity prices. Our sense is that Maruti should show a decent growth in top line as well as EBITDA, in terms of margins. And I think obviously with a very large order book with them, especially for very popular models, I would not be surprised that the markets would obviously look at the kind of growth trajectory the company comments for the second half. Usually, the second half for Maruti is considered to be much more robust because, as you mentioned earlier, and also like paints, car markets also get a strong kind of momentum in the third quarter, which is the festival quarter.
Right. And what about Reliance Industries?
Yeah, I think Reliance Industries, the bigger issue is what is the outlook on the telecom and the retail business, because these are two growth engines which are growing very fast. As far as the oil and gas business is concerned, the rise in crude prices will not have an immediate impact because most of these costs, the crude prices are passed through for Reliance. But I think in terms of the oil and gas business, market should obviously look at any kind of new trigger in terms of expansion or in terms of some strategic tie-ups which the company had mentioned earlier. But I think the telecom business and the retail business would be key data points to share. And of course, the recently announced geo financial numbers which have come in have also given a lot of confidence that Reliance will definitely also boost from a host of its other subsidiaries in the business. So I think net numbers should be in line. No major kind of fireworks, but yes, the market should be looking at some sort of commentary, especially for the retail as well as for the telecom business.
Slightly out of syllabus question for you, Suyash. We are living in this era of demergers. We've seen the ITC story play out. We are seeing the Vedanta story playing out. About time that even Reliance was now heading towards some sort of a demerger to really maximize shareholder value. You've got Jio, you've got Reliance Retail, you've got the oil and gas business, you've got JFS, financial services. Isn't it about time that some sort of a demerger initiation begins at Reliance?
I mean,
and let's not talk about entertainment just yet.
I mean, we were expecting that from, the AGM this time around, because that's what the management said. They'll give us some guidance as to what the demerger timelines is going to be. I think that has been a major drag on the stock also. If you see at the stock, if we are removing that the impact of JFS, which was carved out, it has pretty much been range bound. It has been trading in a range of about 23 to 2800 levels for the longest of times. I think nearly 25, 26 months or so. In fact, even now, from what I can see, Reliance Industries is in that range pretty much. Lower band of that range, given that the market has seen a bit of a correction, but Reliance has not really, picked up from those 2800, 2700 at the higher end levels. And I think that will be, one of the boosters for the stock going forward, that demerger activity, that unlocking of value that investors are, really hoping for to happen in the next quarter or so, over the next few quarters.
And since you're talking about market correction, I think it's definitely a good day or a bad day, as you want to see it, to talk about the bloodbath that is continuing pretty much unabated in not just Indian markets, but markets the world over. What's happening? What dragged the markets down today?
I mean, before I get to what dragged the markets, let's also just give us a quick roundup of what happened. I mean, if you look at the markets, it's just another day, another sell-off. That's how the market has been of late. Nifty also, after it opened at around 19,000 levels or so. But right after it broke that level, there was a steep decline, and the decline we saw throughout the session. Now, Nifty made an intraday low of around 18,837, which was incidentally just about 13 points lower than, our support, what we were expecting would be a support for this session of about 18,850 levels. Sensex, on the other hand, dropped by about 900 points and closed below the 63,200 levels. I mean, the story really is in the broader markets, Karthik. If you see I mean, Nifty mid-cap, it's pretty much, falling in line with the headliners, so nothing interesting there. But the small caps have been resilient in the last two sessions, even
comparatively.
Yesterday.
I mean, small cap is also down. It's not that, it's bucked the trend.
But
it is continuing to be down, not as down as the rest of the markets.
Yeah, but the market is correcting by 1 to 1.2%, whereas small cap, the broader markets are expected to take the bigger hit, because at the end of the day, that's where the, the investors have made the real money in the last few months. So they are sitting on those profits. Also, I mean, when like at a time of volatility, generally investors prefer to move towards blue chips rather than, so they book their profits from the broader markets. But we are seeing, even today small caps was down about 0.3%, whereas Nifty 50 fell about 1.4%. Yesterday, small cap was down about 0.2%. Nifty corrected by, about 1.83% or so.
Okay, let's get an Avinash here. Avinash, you'd come on our show and you had made this correction prediction if I may, that Nifty will actually find its real correct value at about 18,500 or so. Would you stick by those estimates in the next couple of trading sessions, or are you looking at even further lowering of the Nifty on the charts?
No, I think clearly, we could see a little bit of correction on the Nifty even from the current levels, maybe another 150 to 200 odd points. Most importantly, as Suyash mentioned, the small cap and the mid cap space is something which has seen a lot of action from ultra HNI investors, PMS investors, and that is why, despite being a very volatile space, investors have come in, made a lot of money here, and that's why we have seen the damage to be relatively low in this category. But yes, in the large cap category, I would believe that valuations are not cheap. I think there also, if you look at companies like Asian Paints, for that reason, Mart, I think valuations are expensive, and I think you need to now look at sectors and companies very cautiously, because going forward, returns are going to be very selective, and only in those companies where the earnings growth trajectory is good, where the outlook is better, the management commentary is strong. Only there, I think one could see a decent upside, and there would be no easy money now going forward in the markets.
Okay, so yes, you want to talk about the factors which are driving markets. What are we picking up?
I mean, from what I understand, most of the factors are global. Let's talk about 4 factors that have been ailing the markets, in the past 6 sessions or so. Now, there's a fresh spike in the US 10-year Treasury yields.
Absolutely, 5% plus.
5% we saw on Monday, but then we saw a 20 basis point decline on Tuesday and Wednesday. They have retraced that 5% level, and I think it's just below that 5% mark at around 4.95% or so. So that's adding to the pain. Another fact is that US dollar index, which had slipped below that 106 sort of levels,
back well above 100.
It's back above the 106 mark, and it's actually inching towards that 107, 107 sort of levels, which will be a pain point for India and other markets as well. Then there is obviously the Israel-Hamas conflict. Netanyahu recently said that Israel is perhaps gonna do foot invasion of Gaza. I mean, if they indeed put foot to the ground, the situation will only escalate from here on, and it will spread to other regions of the Middle East, which, as we know, is the oil producing belt for the country.
So oil will continue to be under pressure.
And talking about oil, we have seen a bit of a correction over the last couple of days. Brent has slipped from that $90, $92 barrel mark. It's currently hovering around $88, $89, but still uncomfortable zone for a market like us, which is a net importer.
Right. So, Avinash, more pull out from Indian markets at an institutional level and perhaps some inflow at a retail level, because retail investors sitting in India are definitely not looking at US Treasury bonds to invest in. So, are we going to see more outflow of FPIs, FIIs, and we might see some retail participation, which could overall continue to drag the market?
Yeah, I think, as far as the FI flows are concerned, my sense is that as long as the dollar continues to remain strong and the rupee continues to remain weak, fresh dollar inflows are not going to come in, because obviously looking at the currency factor, FIs are very apprehensive now. And with bond yields at almost 4.95 to 5%, there is no major incentive for them to come and invest in India. So that's the reason you are seeing a very major outflows. In fact, yesterday we saw 4,000 crores of sell-off on the cash market side by the FIs. As far as the retail money is concerned, the SIP basket is growing. We have a monthly inflow of around 16,000 odd crores. So I think that is going to give a little reasonable amount of support to the Indian equity, especially the broader market, where you'll see continuously, money being deployed in the Indian equity market despite these kind of panic sell-offs. So I think to that extent, yes, retail money is going to be a very big kind of a supporter. But near term, I think, as long as the FIs continue to sell, the sentiment is going to be quite drowsy and quite negative. So we'll have to wait and watch when the market bottoms out. At least for the near term, it looks as if volatility will continue.
So, more pressure on the rupee. Do you foresee RBI engaging in more selling of forex? Is that likely to continue as a trend? I mean, we have comfortable reserves, not 600 billion worth, a little lower than that, but we are in a comfortable zone when it comes to forex. Will you see the RBI undertaking more selling of US dollars?
I think, we'll have to wait and watch, but clearly, I think on the export side, India has underperformed, and with US and Europe, being major US export markets for us, if our exports don't pick up, obviously the rupee is going to be weak as we get lesser dollars inflow in the country. And to that extent, I think you could expect some action from RBI, but definitely, I think, at least this weak trend in the rupee will continue for some more time.
Okay.
Avinash, talking about FIIs, I was just looking at one of the graphics our producers was playing. Interesting thing playing out there. In the last quarter, it seems FIIs have raised stake in, several of the IT companies. As you can see on your screen, it has raised stake in Infosys by about 16 basis points, in TCS by about 1 basis point, Tech Mahindra by about 53 basis points, and in Wipro about 15 basis points. Now, IT sector has been one of the worst performers, at least as far as FY24 goes in the first 2 quarters of FY24. Why are they buying IT stocks at this point in time?
No, I think my
seems to
guess
be the
is
most at risk with recession impending or dollar index rising.
I mean, that's what the expectation is. FY24 is pretty much expected to be wash out.
Avinash.
I think Suyash, this is interesting data points which you shared, but I think my guess is that at least for the next 2 quarters, IT sector is going to be under significant pressure. Like yesterday, Tech Mahindra reported results, very disastrous numbers, 60% fall in profit. And I think the outlook was also quite cloudy. So I think my sense is that, Indian IT companies are going to take a reasonably long time to get back into action. And I think at least FY24 is ruled out, as you rightly said. Maybe we could look at FY25 with a little positivity. Hopefully, the US and the European markets pick up. But definitely, I think in terms of the order book inflow, the execution kind of lineup is going to be extremely crucial. This was very clear from the cutback in guidance by Infosys. Despite having a large order book, the guidance has been cut down. And even TCS management has clearly hinted that, in fact, despite having a large TCP, the execution is now going to be very crucial. So I think I'll prefer to wait and watch. But I said, FIs are definitely looking at extremely attractive valuations. These are all asset-light businesses with a lot of cash on the books. So the moment some tailwind comes into the market, especially for the IT sector, the bounce back could be equally stronger. So I think that could be possibly one of the reasons. Very attractive valuations, and I think near-term downside is already factored into the prices.
Now, Avinash, we were just talking about the factors that are weighing on the markets. I mean, it's the bond yields, it's the crude price, it's the dollar index. All of them seems to be, imported concerns. So, should we now be more concerned about what the US Fed has to say than the RBI?
Yeah, I think my guess is as a strategy, we believe that, the domestic facing sectors should do extremely well. I think as far as any company which is into the export market, specifically overseas markets like US and Europe, I think those are the companies which are going to be hit the worst. So I think clearly, what the US market does, what are the bond yields, typically what is the scenario on the Israel war, these are global factors which are going to weigh down in the very near term. But domestically, we are doing pretty well. GST collections are up. Typically, even IIP numbers are decent. My sense is that, on the ground, corporate capex is also picking up quite well. Credit growth is also close to double digits. So I think domestic related sectors and domestic related themes are going to play out much better. And I think that would be a very good defensive strategy in this kind of market to protect capital and to expect a reasonable risk reward in the very near term.
So perhaps, I mean, given that India's situation remains relatively intact, would you recommend like buying into the market at current levels, given that we have seen 1,000 point or so correction in the last 6-7 sessions?
Yeah, I think selectively we continue to advise our investors that sectors like automobile, capital goods, real estate, cement, these are sectors where we believe there's a lot of growth opportunity yet on the ground. In fact, most of the real estate companies which have come out with numbers for Q2 have sounded very positive. Secondly, in terms of the private sector and the public sector banks, if you see most of the private sector banks like ICICI Bank, Axis Bank, or typically even a PSU bank like today Canara Bank reported numbers, very strong numbers. So I think mostly I would believe that these are the sector choices which we feel whenever you get a decent decline, one should definitely look at buying more and accumulating when the chips are down. But yes, I think you need to give a slightly more longer time horizon here, because now the risk reward will take a long time to actually pay off.
So, Avinash, I understand, your sort of concern about maybe being a little underweight right now on export-facing sectors and being perhaps overweight, if not absolutely neutral, on domestic factors. But that's from a stock perspective. From a larger economic perspective, IT is too big to ignore in the India growth story. So, if we are indeed looking at a washout here, it is bound to create some pressure on the macros of the country as well. Wouldn't that also eventually weigh in on the markets?
So it will definitely weigh down on the markets, because the services sector is very important. If the IT sector underperforms, it's going to create, as I said, a little bit of pressure on the rupee. And I think it's definitely not good in the longer term because, as Suyash mentioned, that we still are a net crude importer. So it's going to impact our trade deficit number. And to that extent, macro numbers could definitely be impacted. So I think, obviously we need to understand that how long this underperformance will continue. At least in IT, the companies are sitting on decent order books. And our hope is that at least FY24, if not going to be a very strong year, at least even if they can maintain last year's performance, that would be a good sign.
Now, Avinash, also want to get your view on the banking pack. The numbers so far seem good. We have seen a good bit of a jump in profitability. Loan growth has been great. I mean, in the case of Axis Bank, best in 7 years. The banking index, however, on the other hand, is facing the heat. It's down about, 6-7% or so in the last 10 days. What's the story there? Why are we seeing this correction in the Nifty banking pack?
Yeah, I think I've been talking to a lot of people, and Suyash, I think one indicator which I've got to know is that credit costs are going to go up the roof.
Sorry, lost you there, Avinash. Could you repeat that?
I was saying, I was talking to a few people. They were saying that the credit costs, for most of the banks are going to increase quite significantly. And that is going to put pressure on the net interest margin. So that is one factor which is now resulting in some sort of sell-off in the banks. But I think, if credit growth remains to be in double digits, then I think you could possibly see these banks consolidating. I think beyond a particular level, I think as the economy grows, as GDP grows, I think you're going to see a lot of, appetite, from the banks. Banks are finally going to fund all that growth. So I would not be surprised if you look at numbers from NBFC players like Bajaj Finance, Poonawalla Finance, very, very robust numbers. And even the management commentary has been very solid. So I would believe that, you need to give some more time to the banks. Clearly numbers are strong, and I think you could possibly see the third and the fourth quarter to be much better than the first half.
Okay.
Also, just want to do just one final question from me. I mean, private banks in the last few quarters have, really worked on expanding their branch network. Once this, deposit growth, loan growth normalizes, do you see from, operational expenses playing a big weight on their earnings?
No, it is bound to happen because obviously, deposit growth as well as cost of deposits is going to go up. So I think maybe over the next, say, 1 or 2 quarters, you could see normalcy in, deposit growth, or maybe the, net interest margins also obviously, reducing by a couple of basis percentage points. So to that extent, yes, there could be a little bit of pressure on the profitability of the banks, but the, the appetite and the cake size for the growth for most of these banks is very large. Specifically now, since corporate capex has picked up, I think after a long period, we are seeing money coming back.
All right, money coming back. Well, let's hope that trend continues, even though the bloodbath that we are seeing on the market seems a little unrelenting right now. But Avinash Gorakshakar, thank you so much. As always, pleasure having you here with us on Business Plus, and to you too, Suyash. And I think it's going to be the next few couple of trading sessions are going to be very interesting. And let's see which side the tide goes, especially after the big results tomorrow from Maruti Suzuki and Reliance Industries. But let's move on for now, at least. Let's move on to another very, very important story which is emerging on the global front. And we've spoken about India, we've spoken about Indian markets, we've spoken about US. But there's another large economic bloc right now which is seeing only one color, and that color is absolutely red. That's right, the Eurozone seems to be headed, this time fairly concretely, towards a recession. Let's play this short package from Reuters and just try and make sense of what the scene in Eurozone is right now, and whether this long talked about impending recession is indeed upon the Eurozone.
Eurozone business activity showed signs of flagging, and that could have the region sliding towards recession. Tuesday saw release of the October Purchasing Managers' Indexes for the bloc. The closely watched gauge of business health dropped to 46.5. That's the lowest in almost 3 years, or over a decade if you ignore the period of the global health crisis. It's also well below the 50-point mark that separates growth from contraction. The details of the October figures made even grimmer reading. A sub-index for the region's key service sector sank below all forecasts. One economist told Reuters that the numbers indicate hiring is all but frozen in the sector, while manufacturers are actually ramping up plans to shed jobs. Forward-looking indexes also sank, with numbers on new business and future output both declining. Put it all together, and some market watchers say it would be no surprise to see the Eurozone enter recession in the second half of the year. For now, though, that isn't quite the consensus view. A Reuters survey of economists predicts growth will flatline, but not fall, over the current quarter.
All right, so a likelihood of Eurozone going into recession, but no consensus on that just as yet. Joining me in the studio to discuss this is my friend, my colleague Amit Ranjan, and of course, our long-lost friend joining us from the road. Thank you, Srinath Sridharan, for taking time. I know you're traveling and you're in the middle of a journey, but thank you so much for joining us to understand and help us make sense of what is really going on in Eurozone. Is there a recession really coming, Srinath?
Hi, Karthik. The challenge for Europe is, I think they're in denial. This has been coming for quite some time, whether it's ECB statements or different countries talking about it. Nobody wants to accept that they've been in slowdown for so long, be it manufacturing or services. Now, for example, the services indicator which has come out is finally saying that it is flatlining. And even now, if you look at the most of the commentators from the Europe, I think they're doing the semantics play, talking about flatlining, plateauing. They're not saying it is declining. It has been declining. And of course, I think it has got a huge bearing on the Indian services industry, which works with European clients, because they're going to see a lesser number of business or huge margin pressures. Two, I think the historic challenge for Europe is their manufacturing or SME manufacturing, which they were very big at, for example, Germany, completely flatlining, and they're struggling with how are they going to get orders, forget fulfilling orders. And during COVID, they all spoke about, I think, shifting of regional supply chains. Forget the regional supply chain. Today, they need something to supply, and I think that's a basic problem. The fourth one, I think, what is the elephant in the room is, did Brexit actually work? Is there a common thing like Europe at all? Each of the countries are actually using the word euro in a different way, but actually are doing infighting amongst each other. And I think that's the elephant in the room that we need to speak about. And that is a large challenge because they're also competing with each other. You see reluctance of different European countries or customers wanting to pick services and goods from other European zone because of simple thing, trade disputes, which are still struggling. Consumer dispute resolution is still a challenge between these. I think these are micro, but they all add up to the larger macro that euro, according to me, is in recession. It has been on for quite some time. Probably sooner or later they will have to declare it. I think that's a challenge they have.
Right. So some very interesting points you mentioned, Srinath, and let's take them one by one. Number one, you're saying Europe continues to live in denial, but we've seen data emerging from Germany absolutely bang on smack in the middle of recession. We've seen 2 quarters of recession or sort of, below zero growth or deflation, whatever we want to call it, even in France. So this denial is definitely not reflecting in the numbers from 2 of the largest economies of the Eurozone, which is Germany and France. Now, add to that, another interesting aspect that you mentioned was about the infighting within the Eurozone. I want to leave that aside right now and talk about the outfighting which is happening in the rest of the world. 2 wars, Russia, Ukraine, and then you've got this conflict breaking out in the Middle East. Now, do you think Europe, for its own sort of, whatever model ground that it took in the Russia-Ukraine war, is now beginning to actually suffer on account of the sanctions imposed by the West on Russia? Do you think it's time for them to bite the little humble pie and say, hey, okay, let's just ease out and maybe look at this entire oil story afresh?
So I think, Karthik, here, let's bring the conversation about greenwashing. A lot of these countries are actually doing greenwashing, right? They're buying the same Russian oil through other countries, including India, and actually claiming it to be very, very clean. So this kind of, and the reason why I call it greenwashing is, how do they actually then run their furnaces and heaters in the winter if they don't get this oil? That's a domestic compulsion that they do. So the challenge for a lot of these Euro politicians, political leaders is this: whatever they might be their outfighting or the conversation they might have about other countries, the challenge is they have to keep their domestic constituents happy, and they're struggling with it. Inflation, cost of money going up, not enough jobs, not enough orders, export orders, most of those countries are not self-sufficient when it comes to agriculture as well. So that is why the Eurozone originally was supposed to be very, very seamless. So I'm actually wondering and speculating here, is UK going to benefit from a lot of these Euro problems? Can UK get its act right? Of course, they have their own challenges. So that some of these, what they lost out in Brexit can go back to UK, will it? And
right. So let's take this to Amit Ranjan. Amit, PMI data has come in and we've seen the S&P PMI, the indicator of 50, anything above 50 showing growth, anything below 50 showing degrowth. It is well below 50. So do you agree with Srinath? Are we really looking at Europe, despite all these data sets, living in denial?
Below 50, not just for the entire Eurozone, the Purchasing Managers Index, but Germany and France consistently have, the PMI has been below 50. We have seen negative growth back to back in the entire Eurozone for 2 continuous quarters. Another 2, we are into a recession.
Right.
The output has been negative for the entire Eurozone for the last quarter.
And that's 20 countries we are talking about, averaged out.
Yeah. So leave out Switzerland and leave out the Scandinavian countries,
course, which are not part of Eurozone.
Not part of Eurozone. So yeah, the world should not be caught off guard if Europe slides into a recession as early as the end of this year.
So Srinath, let me come back to you. What is it that the ECB can do? ECB has come on record last night, India time, and said that it will possibly hold rates. It's not looking at increasing rates any further because in any case, the country is slipping into recession. Inflation is an evil you have to live with. So rate hike has pretty much been ruled out by ECB. Now, what are the levers available from a monetary policy standpoint to prevent the zone actually going into recession? Because it will have ripple effects on the rest of the world as well. We will have demand even from India, leave alone China. Of course, Chinese goods are flooding every market, but even the IT sector exports to Europe are going to get hampered. The trade between Europe, Eurozone and US is going to get impacted. And of course, we spoke about outfighting in the middle of wars, and crude prices are only likely to shoot up if the war continues. So overall, are there any levers available in the hands of the ECB now?
So I think the only one which any central banker in Europe will do is to create local consumption. I mean, how are they going to allow for consumption to pick up? Because that will get the cycle of growth going, at least in the services and the local goods produced. And I think that's a challenge they've been facing for quite some time, and which is what I spoke about, self-sufficiency. How can Europe, how can ECB bring back consumption? I think that's a larger challenge. Whether they do rate hike or rate decrease, you need takers for it. And today, money is almost for free. And what do they do with it? That's a large challenge they have. 2, the energy cost has been increasing for Europe for quite some time. And if you look at, let's say, Germany has been speaking about, has been using nuclear fuel, renewables and others. They have not been able to bring unit economics for a lot of these renewables. Whereas if you look at India, we have been able to bring down unit economics of renewables far cheaper than the fossil fuel. Again, It's a learning for Europe that they will have to do innovation from, it need not be from, I mean, I'm politically incorrect here by saying white man's game, but look at what a country like India is also doing and take it there. I think that's a learning for them. And 3, their entire payment system, I mean, the banking system is, I think, pre-digital era. I mean, they will have to disrupt that and bring it to digital. Indian travelers still carry traveler's check, credit cards and all that, no digital payments being made. Yeah. I think that will also bring down the cost of banking services. That's something that they need to apply to. Multiple things, lots to be done there.
Multiple things, lots to be done. Srinath Sridharan, thank you so much, and onwards to your journey wherever you're headed. Thank you so much for joining us here on Business Plus. Amit, stay with me. Let's move on to another very interesting story that we are tracking, and joining me now is, of course, our dear friend Mohit Gang. Mohit, good to see you at this time of the hour. You usually join us in market hours, but I think a very, very interesting development which has come by way of SEBI, really cracking the whip this time, very, very, painfully, on what we refer to as FINFLUENCERs. Now, the company in question, or the FINFLUENCER in question here, of course, is Baap of Charts. Honestly, I had never come across that FINFLUENCER because I heed to good advice given by SEBI-registered investment advisors like Mohit Gang. But I think enough and more people seem to have, paid for courses offered by Baap of Charts, and now SEBI saying, hey, buddy, hold it. First deposit 17 crore rupees in an escrow account, and then let's talk. What is the message, according to you, that SEBI is really trying to pass down to the finfluencer community, Mohit?
Oh, I think this is a blow out of the blue, honestly, I think, and this is a very
Is it out of the blue?
hard-hitting,
Weren't you
very
expecting it? I think all statements that have ever been made by Madhvi Puri, Butch, the kind of debates that we have seen around crackdown on finfluencers, to my mind, it is pretty much in line with what should have happened, has now finally happened. So really, is it out of the blue?
It should have happened. It should have happened. What I'm meaning to say is we've never seen that kind of action by Indian regulators in the financial market. Like the amount which we are hearing, I think 17 crore is an unheard of kind of an amount in Indian markets. We've never seen. Look, all of us have gone through these things. We see number of influencers out there on X, on YouTube, trying and promoting multiple things, and we know hand on heart that half of those things are like really outrageously false, right? And half of those claims are also made out of thin air. But something of this magnitude to happen, I think that's a very, very welcome move. Honestly, I think it's much needed for sanity of the overall ecosystem, much needed for sanity of a highly decorated role, which is an RIA or an registered investment advisory role. I think the role has got, honestly, I think it's got ridiculized in last couple of years by a very, very small segment, and they have come to represent the entire fraternity per se. It's unfortunate, but that's the true part of it, that those handful of people who give these trading calls, who give derivative tutorials, who give these lessons online, and who claim to be really influencing, but they do have huge following on social media handles, is what is distorting the entire narrative now against the registered investment advisors. And honestly, I think from a regulator's perspective, they have to make regulations which are at par for everyone, and which is where the cost of compliance is, which is where the cost of managing the regulations has gone up for genuinely for genuine advisors. I think the economics of doing the whole business is getting tougher and tougher. But I think for larger public, for retail public, for public who's gullible and who's falling for these kind of things, it's a very, very welcome thing, honestly. And I think more such examples need to be set so that the entire ecosystem is very well aware. And plus, public at large also tries and distinguishes. Yeah. Before they go for these kind of things, they try and distinguish who is a genuine RIA and who is not a genuine RIA.
So, I just want to play devil's advocate for precisely 1 minute. We are running out of time, Mohit. But do you think it's fair to treat financial influencers or finfluencers very differently from regular influencers? I'll just give you a simple example. If there's a travel influencer I follow, that travel influencer tells me, hey, visit so-and-so country in Europe, eat such and such food, visit such and such museum. At the end of the day, it is my money that I'm spending on the advice of that travel influencer. Or if there's a food influencer who tells me, hey, go to this gully in Purani Delhi and must try this tikki, and I go there and I get a stomach upset, I'm still following some influencer and I'm still parking my money. Should financial influencers be treated very differently from other influencers, and hence should the role of SEBI not border with the rules of, let's say, ASCII, which defines the advertising guidelines in general for influencers? I'm not making a case for influencers. I'm just saying objectively, does it make sense to bucket and go after just this one lot of influencers who actually have also imparted perhaps, I could be wrong, but they have imparted some sort of education, some sort of learning for people to at least understand the macro concepts of markets?
Yeah. I'll try and answer your question in two parts. The first part is where you make a comparison. Look, honestly, I think where your hard-earned money is involved, where you are actually spending your life's savings for your retirement kitty, for your wealth creation, for your children's education, or any other financial objective which you want to meet, that's a very, very different thing as compared to a travel thing or eating some dining out in a restaurant. You can have that bad experience. You will, in fact, most of the people I see do a lot of research before actually going out to travel and trying out a new restaurant, but they
don't do that research for investing in the market,
and they make investments.
They don't do that research while they don't do that research. Similar
honestly,
research
they don't. Actually, they don't. They go with these influencers and they go with the commentary on YouTube and commentary on X, which is the most disheartening part. Actually, no one wants to do the hard work of actually analyzing the products and analyzing the background of the person who is actually recommending the product. But to your second part, my second part of that entire answer is, look, we need to have a clear demarcation as to what a influencer can do and what he cannot. Yeah. What kind of a registration does he need to have? Is he advising clients, or he's just trying to deepen the market by doing educational tutorials, or is he running his own courses, giving tips, promoting other platforms? We need to have a clear demarcation. And I also feel we need to have a distinguish categories of RIAs as per products,
Right.
which is enable all RIAs, whether they're doing mutual funds, they're doing stocks, or they're doing derivatives under one common bracket,
Yeah.
and try and cast them under same rules. My sense is if we have different set of rules, because someone who is doing mutual funds is trying to give
May not be
a
an
genuine
expert
advice
on tax,
transaction.
may not be an expert on stock picking, may not be an
Yes.
expert on fundamentals. Absolutely, get your point, Mohit. Thank you so much. We are running out of time. I think I can only end by saying and adding a little bit of my sort of twist to the famous NSE saying, सोच कर समझ कर FINFLUENCER की नहीं RIA की सुनकर invest कर. Well, thank you so much, Mohit Gang. Wonderful having you here with us. And of course, we'll continue our market discussions in due course. But for now, thank you so much for joining us. Amit, Mohit was talking about FINFLUENCERs taking to platforms like YouTube and platforms like X. Now, our favorite man, Mr. X, Elon Musk, is up to another little trick. What's he got up his sleeve this time?
And Elon Musk, being Elon Musk, he has done it in a very dramatic way.
Okay.
Users were greeted with "ready for it"
Okay.
some time back, some of them.
Okay.
Then they were
Ready for
greeted,
what?
Yeah, so then they were greeted with this message, and I believe some of them have it. I don't have it as yet. Audio and video calls are here.
I saw that. I saw that notification.
So, yeah, but it's
today.
not with me.
Okay.
So it's not come to. So some active. So now audio and video calls are available for some users. Whether you have you tried it?
I haven't. I tried
Yeah.
to try it. I
So,
could not actually get
so
my hands
Chris
on it.
Messina,
but the
who is
notification was
the inventor of hashtag, says he speculates that it'll be only available to subscription premium users.
I'm not one.
Yeah, so probably that's out. But it is a very simple thing. You can go on your DM with a certain user, a friend, or this thing, top right corner, you can click on the phone icon and then select whether you want to do an audio or video call.
Why would I use X to talk to a friend? I have the normal phone app. I have WhatsApp. I have enough and more messaging, calling tools, Skype, Zoom, MS Teams, the works. Why will I go to X to make a phone call, Amit?
I'm just spitballing here. X is a platform where you get running news. And two people who want to play commentary on something that is happening, maybe the next thing that Elon Musk
Go
is
to
trying
Twitter
to...
Spaces,
It's a
invite
game.
more people to
It's a
join
game.
that conversation.
It's probably a game that people may get addicted to. Is probably, and I'm again spitballing here, that what Elon Musk may have in mind.
Is it Elon Musk trying to get one step closer to X becoming a super app?
You nailed it. So he's
So
trying.
can I make a phone call
It is an
eventually?
out of the box thing, because, like you said, a phone call, you don't need to go to X to make a phone call or a video call.
Yeah.
But what is he offering in addition? A super app where you can do other things with the people you are calling. Now
So it starts with making a call. I can end up transferring money. I can end up sending you gifts, and at some point, I can perhaps go to somebody's handle and shop from there as
and
well.
not just that. You can right now, you can call somebody who is on your phone, on your address book. You can call somebody you're following, or you can call any user.
All right. So
X,
with
or
Elon
all
Musk's
three.
new brainwave, there is seemingly no end to spam calls. If anything,
Yes.
one more platform to likely get spammed on. But that's all we have time for here on Business Plus. Amit Ranjan, thank you so much. Wonderful being here with you. And with that, it's a wrap on this edition. See you again tomorrow. Goodbye.